As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. So, I mean, if you take a look at an option like this over time, let's say that the stock doesn't really move. If over time, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact, that the stock did not go up in price, that you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit, because they sold it to you at 40 cents. They can buy it back at 10 cents, making 30 on that trade. Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, then eventually this option will be worth less and less each week. Let's say next week at this time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only worth 35 cents to 45 cents. Now another week passes by, and it's only 25 cents. See, as long as the stock does not move, these options, all of these options will continue to decline in price if they have extrinsic value. Now the prices of the options, these are called in-the-money options. The in-the-money options have some component of what they call extrinsic value and some component of intrinsic value. And the way you can determine intrinsic and extrinsic value is simply by taking the strike price of the option. In this case, we're taking a look at the May 20 calls, and they're priced at $7.40. On these 20 calls, if you add the strike price to the price of the call, you get $27.40. At the mid price, you're probably talking about closer to $27.25, which is exactly the price of a current stock. So you could say that this call option has no intrinsic value. In fact, if we look under extrinsic value, you can see that it is actually zero. The closer you get to the at the money, or the actual price, strike price of the stock, you can see that there is in fact some extrinsic value left. There is some time value left in that option, and that time value is basically saying that, hey, you know what? We do have 3 or 4 weeks before expiration, so the price of the option may actually increase to the point where it might be actually further in the money. What is our objective, though? Okay, this is just a very brief. You should have already a basic understanding of options. I probably haven't told you anything new, or maybe I have, I don't know. But depending on your experience. The important thing to remember, though, is that when we trade for monthly income, the stock cannot be in two places at one time. At expiration, we're going to make money on one side or the other. And that's an important distinction to make, because we make money whether the stock goes up or down. Now, the types of vehicles that we use in order to trade options on the exchanges are normally going to be, and I'll go through all those with you in the next series here in portfolio building. What we're going to be using are adjustments. Adjustments are everything because, as I said, prices fluctuate. And that's one inviolate rule of the market. Prices will fluctuate. We don't care if they go up or down, but they do fluctuate. There's a couple rules of the option markets, and that is that the two I've already told you. The third one is don't lose money. Okay, so yes, the rules are prices fluctuate, options expire at a date in the future, and the third rule is don't lose money. So in order not to lose money, many times we have to do adjustments to our original positions. And this is where a lot of option players make a mistake. They do not adjust their positions. They put a position on, they believe that they can just keep it on there until expiration. Well, they forgot about the other rule of the market, and that is prices will fluctuate. Options expire, but they also fluctuate. So if you get into a position, and a lot of option players do this, they just put positions on and they forget about them, and they don't even look at them until they have a loss. And then it's too late to do any type of adjustment to that position because they're already too far gone. Our goal is to monitor your positions, put these positions on, and then we will show you exactly what you need to do in order to adjust the positions, and that's where the majority of the real profits come in this business. Because, what happens to a business when it's not making money all of a sudden? Well, just like this, if we're not making money, then we have to take a look at the source of the problem and adjust our strategy in order to take advantage of new market conditions. And that's exactly what any business has to do. Any business who is not in a profitable position has to take a look at their business model, and exactly what we do in our business of trading. And that's why it really is a business, because we manage by numbers. And that's what all good big businesses do. They manage by numbers. So now this is an aggregate position of our demonstration account for the purpose of these videos. You will see this throughout all the videos that we're creating on this strategy. We start out in a cash position, but I also want to show you what the profit potential of having more contracts. Eventually, as you get experience in this type of trading as a business, you're going to be able to have a great deal of confidence in your ability to adjust trades over time. I suggest that you begin with paper trading. Now, the thinkorswim platform has a paper trading account that you can set up for free. It looks identical to this. The only thing that is different is if you look up in this top left-hand corner, this is a live trading account. It has a red symbol here with the thinkorswim symbol and logo. If you have a paper trading account open, this is a green symbol. But the platform is absolutely identical. Everything is exactly the same. You can enter trades, you can adjust trades, you can look at charts, you can monitor your account. You can do everything that you can in a paper trading account with thinkorswim as you can in this account.